November was an eventful month for financial markets and was generally positive for growth assets. The key reason? Well, it was comments made by the US Federal Reserve on the pace of future interest rate hikes. So markets are now widely expecting a 0.5% increase at the 14th of December meeting. Now this follows 4 straight 3/4 basis point hikes. Interestingly, US inflation last month was up 7.7% from a year ago, and that's the lowest reading since January this year. So as we move into December, a key number that investors will be focusing on will be the non-farm payroll data. Now this is made up of labour data from goods, construction and manufacturing companies across the US. So in other words, it's a barometer on the state of US employment. So if non-farm payroll data increases too quickly and too fast, it can be interpreted as a foundation for an increased inflation, and of course this is not good for the economy. So if a higher expected number is delivered in December, this is likely to influence whether the slowing of the pace of interest rates can actually happen right now. And of course this will impact what the market thinks. Keeping with the US, November saw the Thanksgiving holiday at the end of the month and straight after Black Friday, the start of the US Christmas shopping season. And trading over this period will always be eagerly anticipated. But this year sales got underway against a backdrop of persistently high inflation and slowing economic growth. So again, the market will be watching this data very carefully over the next few days and weeks. Moving on to other markets, well, European shares perform well on the back that central banks might slow the pace of interest rate increases. Whilst moving to China, well, China's still grappling with COVID restrictions, and this continues to impact that market's performance. Looking at factors, well, it was quality and value that were some of the best performers over the month. The recent recovery in pricing in defensive assets has continued, with both the UK and US 10-year yields continuing to fall from the start of this month. This is because markets are still trying to price in a peak in interest rates, maybe into 2023. Worries remain, however, about the inverted nature of the yield curve. What does this mean? Well, it means the yield on a longer dated bond is lower than a shorter dated one, and that's not normally the right way around, and this can actually signal impending recession. So again, investors will be watching the shape of the yield curve very closely over the next few weeks. So looking ahead, as we enter the festive season, there is historical data to show that US stocks have risen during the last 5 trading days of December and the first 2 days of January. And this has worked around 75% of the time since 1945. So after what's been a volatile 2022, investors will be hoping this year for this Santa Claus rally to work once again.